Good afternoon, everyone, and thank you for joining us. So today's discussion comes at a pivotal moment for markets following the recent reintroduction of tariffs by President Trump. So this policy shift's already influencing global trade dynamics and market sentiment, and it's a development with far-reaching implications and one deserves careful consideration from an investment perspective. So today we're joined by two highly regarded members of the investment team, John Abernethy, Chair and Founder of Clime, and Stephen Lambeth, Portfolio Manager. So we're going to start with about a 30 to 40 minute macro overview, backdrop, which will touch on markets and policy direction, and then how that might impact the investors on their journey ahead. Following that, we'll move on to a Q&A session where John and Steve will respond to your questions. You're more than welcome to submit questions during the talk. So if you can message those to me, I'll collate those and I'll share those with John and Stephen at the end. So with that, I'll hand over to John and Steve to get us started. Thank you.
Well, good day, everyone, and welcome to this briefing session. It will be taped as well, so if people want to review it at a later date, they can. So I'm going to go through the macro, and Steve's going to go through implications for the Australian share market. As Gareth said, about 45 minutes, and then time for questions. The outlook for the world is certainly to slow. So if you go back 6 months, most international forecasters, OECD, IMF, were talking about growth into 2025, but we're now pre-downgrades, particularly in the developed world, so Europe and North America, but also we've got some downgrades coming in China and India, but we don't actually know by what extent, and how quickly they'll come on board, because it is a moving feast in terms of the negotiation around tariffs. Inflation was projected to ease in 2025. Now we don't know, particularly in North America with tariffs. There's only one way inflation can go, and that's up. And that's because of the import pricing pressure. Also, there was a forecast for energy prices to decline, particularly because of Trump, because he was going to increase production coming out of North America. It looks now that that's going to accelerate on the downside, but there's only so far it can fall. In terms of Australia, we see cost pressures moderating, and China deflation may accelerate. China's deflation was appearing like it did pre-COVID. We saw that beginning to appear in the last 12 or so months. It may well accelerate with these trade negotiations going on. We'll cover that. Australia has been going through a income recession in terms of wages have not been growing as fast as inflation. There was a catch-up going on, but if you look back to COVID, wages were about 10% below cost of living increases over the last 4 years. Where come interest rate adjustments down, you can be a little bit more bullish here given what's going on in America. If there is a downturn in America, you can say that there'll be an acceleration of interest rate cuts, and the outlook for the forward yield curve is potentially 1% over the next 12 to 18 months, cut in interest rates. Then we've got the US Australian dollar dilemma, which we talked about endlessly. Australian dollar weakened very dramatically after the tariff announcements. We fell about 5 or 6%, and now we're up 5% back to where we were. In terms of just looking through what's going on with Trump, we can talk about a game of chess. Arguably, Trump doesn't play chess; he plays cards, but that's a bold statement. Okay, so let's just go back to the play for Trump. We've had the tariffs being threatened and used with a targeted outcome. What are those outcomes? The outcomes are to try and balance the trade account, to try and slow the American economy and get the fiscal deficit down. And unknown is what the target is in terms of currency, but also to deal with the bond market and try and lower the cost of debt to the American government. I'm going to cover all of those as we go into the charts and tables. In terms of the implementation of tariffs, what may happen, it may drive Europe, China and Asia closer together in trade. And I think that's come to the forefront in recent discussions. So I don't think that's a risk, that's more a likelihood. Already China is talking to its neighbours in the last few days about pushing forward on closer trade and manufacturing alliances. There is the preliminary discussion, which was prior to these tariffs, the US, the Trump administration had been asking Europe to increase their defence expenditure into NATO. I think that's a certainty to occur. And I've said this on a few views recently that Europe's investment in defence is positive fiscal policy in terms of supporting growth. So if there is positives, there is stimulation going to happen in Europe anyway through fiscal policy in the manufacturing sector. Trump clearly has to get inflation under control as he renegotiates the massive American debt. One way of doing it is driving down the oil price. The oil price will fall with supply coming out of North America, and if there is any dislocation in economic growth around the world, demand. And that's playing out as we speak. Oil price sitting around $60 a barrel, about 30% below where it was 6 months ago. What may happen in terms of risk? The devaluation of the Chinese yuan. We're already seeing China devalue slightly, and that's against the very weak US dollar. And we'll talk about that again in the charts. But before we go on our journey, let's remember the crisis is normal. And this is just covering the last 14 or 15 years. It's fairly regular events that something happens. So now we've got the 6th event since the GFC. And the GFC was a major event. So we don't need to go through each of these. But as investors, we have to acknowledge that there's always turbulence coming at some point in time. Some of it is black swan, some of it's white swan. I'd actually say that what Trump's doing now, it's more element of white swan because he flagged it. He's been flagging it for 20 or 30 years. So it's not as if it's a black swan event we didn't know about. So let's look at the charts and just see what they're saying. There were downgrades in terms of world growth appearing after very strong 24 growth around the world. I expect those arrows to point further down, but I don't see a worldwide recession. That's the point. We're not looking at negative worldwide growth. And we've already seen pivoting occur. So what we're seeing in terms of tariff policy stated may not be tariff policy implemented. We have to be very clear on that. This has a long way to play out, although the timeline is very short because of the election cycle in America, and we'll talk about that as well. It's interesting when you look at debt, and this is all about, there's two big issues. It's the trade account of America and the budget situation of America leading to a debt problem for the American government. And there's the three major economies. America's debt, everything surged during COVID. America's debt's beginning to go up again, and its debt's beginning to grow faster than its GDP. Similarly in China, very significant government debt growth. So we've got our two biggest economies in the world, around slightly above or slightly below 100% the GDP. Europe, which was the basket case coming out of the GFC, has managed to decrease its debt to GDP by growing faster than its debt and also getting some fiscal policies, and particularly Southern Europe, under control. There's always a question about who owns America's government bonds. And if we scan across it now, we see that government bond ownership is around 75% Americans, American citizens or corporations or pension funds, and 25% the rest of the world. The extent that the rest of the world has invested in bonds has been declining as percentage of all bonds on issue. And obviously, if we go back 10 years, the Federal Reserve ownership of government bonds through QE didn't or hardly existed. The biggest owner of American bonds is the Central Bank of America. The big question mark we have today, looking out, will that increase or decrease? I think there's a lot of thought process suggesting that the Federal Reserve will have to increase if the interest rate of American government is to come down. Now, how significant is the deficit problem? This was up to the end of February, I think. So October to February, with still 7 months to go to the end of the fiscal year of America. The deficit, even after 5 months, was running well over $1 trillion. So we're heading to a deficit in America of somewhere north of $1.5 trillion to $2 trillion. There are seasonal flows in terms of tax collections, which you have to be aware of, but it is deep in deficit. The things I pointed to there is that the interest bill is rising rapidly, and the interest bill now approximates the defence bill. And interest as a percentage against receipts, similar to defence. And this is, again, we've got to be careful seasonality, but you can see that the interest is about 12% of income. So it is pretty significant. Interest bill is going to rise. And why is it going to rise? Is because if you look at the previous page and dissect it, the interest being paid by American government is about 2.5% of its debt. Well, if you look across the American bond market, nowhere is interest rates 2.5%. So it's all historical debt and bonds issued in a previous period, a lot through COVID, obviously. And that debt's going to be rolling into higher interest rates in the bond market, plus new debts being issued. So if the American government's got $2 trillion deficit, it's got to issue $2 trillion of bonds to fund current year deficit, and it's rolling over $6 trillion of bonds each year. So about 20% of its bonds roll. So you get to this 8 trillion. Every time the 8 trillion is issued or rolled, it's going into 4% interest rates, not 2.5%. And you can see the trajectory of the interest bill going up and up. So we're running well over $1 trillion of interest. I projected if nothing was done, we could see a $2 trillion interest bill in 10 years' time. The fiscal deficit, which deteriorated rapidly during COVID, has begun to get worse again. So you could talk about COVID being an aberration. So if we take COVID out and just look at the trend line from 2015, it's just up and up and up. Trend going from $500 billion deficit 10 years ago, heading towards $2 trillion deficit now. Pretty steady line apart from the aberration of COVID. But COVID did add substantially to the debt load. America's foreign trading situation is made up of goods and services trade, and it's made up of income flows off investments. The trade account is about a $1.2 trillion deficit, taking in goods and services. You can see from that chart probably about a $1.3 trillion deficit on goods, about $100 billion surplus on services. And America's income off its foreign investments is the blue line at the top. Now, one thing you can see from that trend line is that the income that America is generating on investments is declining. Services is pretty steady, and goods has declined dramatically over the last 5 years. The red line gives you the summary. So it's gone from about $120 billion a quarter negative on current account in the current quarter. Well, sorry, a year ago, but it's still running at that about a $250 to $300 billion deficit per quarter. What's happening with trade with China? This is the big issue. This is slightly out of date, but I can update you now that the estimate is that China, pre the tariff war, was importing about $500 billion directly into America, and America was exporting back to China circa $200 billion. So there's a deficit of around $300 billion. And that's direct trade. There's indirect trade because China uses third-party countries to export into America through Vietnam, Cambodia, Thailand, Mexico. If we add that up, the deficit with China related and direct is about $500 billion, and hence the interest in the American administration in bringing it under control. Given that there's such a big deficit and that the income, which I showed you on the previous page, the investment income is dropping, it's become a very acute issue. And arguably, if the current administration didn't deal with it, a future administration would have to deal with it. So there's a lot of criticism and probably the way Trump's behaved and how he's done this, but the issue was not going to go away and it was going to get worse. So there was a trigger point. Trump's brought the trigger point forward. And what I'm showing you is why he brought it forward and how significant the issues are which the American administration, indeed the whole government, has to deal with. What does US import? And it's quite significant. Passenger cars, we know that that's a big issue coming around the Canadian border. A lot of car manufacturing back and forth, components, bringing it all together. That's a bit of a confusing issue because how many times can you tariff a component going back and forth? Pharmaceuticals is interesting, and why America has allowed its pharmaceutical manufacturing capacity to drop to this extent is an unknown. There is increasing income, and I want you to understand this, increasing evidence through the income account, the trade income account, that American corporates have not invested a lot of their profits and their retained earnings offshore. Hence, a lot of manufactured goods come in to supply multinationals to then export again to the world. It's quite a bizarre situation. That pharmaceutical issue, we know Trump's going to address it. He's talking about putting tariffs on pharmaceuticals. Now, there's lots of different types of pharmaceuticals. Some are drugs and some are disposables. In terms of China, they supply a lot of disposables. The Asian region, a lot of surgical disposables. Pharmaceuticals are more Europe and I guess other parts of the world, Japan, Korea. So let's see how that plays out. Quite interesting, that deficit. Crude oil deficit, that's mainly Canada. So is that a deficit or not? So Canada has a very big sway over America. So there has been some withdrawal of his aggressiveness towards Canada. Then you've got the automotive parts again, Canada, and cell phones, 100 billion, mainly China. And what's happened in the last few days, he's dropped the tariff on cell phones and other household goods. If you put 100% tariff on, pretty simple, you have $100 billion of imports going to $200 billion because you've added $100 billion of tax collection. That's a massive impost. Then you can see the electricals there and computers. So in the first round, who did it affect? Vietnam was a big target as a manufacturing base for China. Mexico, this was the drug issue coming across the Mexican and Canadian border, so they were targeted. And then you drift down. So this is the effect potentially of GDP, the reduction in GDP caused by the introduction of tariffs. Australia right down the bottom. Not a significant effect directly on the tariffs coming from the American tariffs. The issue on China, now this was a RBA estimate 2 weeks ago, and they said the tariffs at that stage was going to affect China's growth by 0.3%. Now the tariffs, as we know, since then have trebled. So does that mean that the blue line goes dramatically across above 1%? Probably does, if China doesn't react and doesn't stimulate. Another issue which I think is Trump's exposed is the tremendous performance of the US dollar, which has been on a one-way rising streak probably in the last 12 or 13 years. You can see it there, going back to historic highs. This is a trade-weighted index of the currency from Bloomberg. And yeah, the American dollar is at dizzying heights, nosebleeds. Is it justified? But America has been consuming the world's capital, the world's savings. I've talked before about how Australia's superannuation industry is diverting a lot of money into the American economy now. But that's a feature of the whole world. It's interesting when you look at the ownership of American bonds, the inflows into America have not been going into the American bond market. They've been going everywhere else, mainly into the equity market. If the equity market stalls, less investment in America, maybe the US dollar corrects. And I think we've seen signs in the recent correction of the equity market, the correction in the US dollars. Is it sustainable? We just don't know yet. But certainly given the debt situation, that blue line has been going up against the fundamentals of the American economy, like increasing debt, poor trade deficit, poor fiscal policy. There's no doubt, as I said earlier, that Europe will be forced, and I think now will welcome, in terms of fiscal stimulation, a significant investment in defence in the NATO arrangements. The argument of the American administration, particularly Trump in 2016, 2017, 18, about NATO not contributing, the Europeans not contributing enough to NATO. You can see that America's been contributing, I think, circa two times that amount directly. So he said to Europe, you've got to increase your expenditure, and that's the outlook. So almost a doubling in the investment by European nations. And whether we like it or not, it is stimulation to their economies at a time when they probably will need stimulation given the trade issues. Now, I'm going to talk quickly about Australia before handing over to Steve, just a few charts, which will sort of get him talking about the equity market and what could happen. China is back to exporting deflation. This is before the tariff decisions and the discussions. There is an argument that if China slows its trade with America, it will redirect its trade elsewhere. The question is does that become also a reduction in price of exports? Is there some dumping going on? The Western world is obviously watching it. particularly in some manufacturing and significant manufacturing, steel, automotives in Europe in particular, they will push back against dumping in Europe by China. Australia, in terms of, are we concerned about dumping? Yes, maybe in some steel products, but if they started reducing prices across a whole lot of other electricals and textiles and white goods and things like that, would we be that concerned? Probably not. So it will be a full throttle downward push on inflation if that occurs in Australia. I said earlier that inflation has been rising much faster than wages, and Australia stands out. We have had a significant decline in real income since COVID. The numbers are circa cost of living up 20% plus since COVID, wages up 12 to 14% since COVID. Now that gap is closing and wages are beginning to match inflation, but the damage has been done and we had the real income decline. Arguably that was justified by the lack of productivity coming out of Australia. So we actually have gone backwards in terms of production against working hours. You can see the blue line negative, in contrast to America, the red line below, where they actually have been becoming more productive, and that's flowed into corporate profits, particularly from their big companies, and justified earnings or caused earnings growth and then stock market performance. That's quite stark. Australia has to deal with our productivity issues, and the current election is obviously not addressing that. There's nothing for me to party. Australia has grown, despite what I said on the previous page, with real income decline of the household sector, but there's been real expenditure increases by the government sector. So that's just a summary from the ABS. But to fund that growth, we've had significant increases in income tax, non-indexing, as you know, as wages have grown more solidly in the last 2.5 years after they plateaued after COVID. That's gone straight into income tax collections and helped the government stimulate the economy. So that first issue was the budget went into surplus, as you know, for 2 years, drifting back into deficit now as the expenditure side gets turned on and the indexation of income tax pulls down that ratio. The other issue, and it's right in front of the election campaign. I know Steve might talk about this, but our view prior to an interest rate cut, and we'd had significant interest rate increases from the Reserve Bank, which you know, it looked to us that the housing market was about to plateau. It's had an extraordinary run since COVID. We talk about cost of living up 20%. Some parts of Australia, housing has gone up by 50, 60% over the same period. So incredible disconnection between what people can pay, what they can borrow, and to purchase. So you can see that I put the line there. The borrowing capacity against the house prices, particularly looking at Sydney house and land packages. So house and land packages around $1 million. With interest rates going up, the capacity of households to service debt reduced, so their capacity to pay the $1 million was substantially reduced. They have to make up the difference with debt. And that's one of the reasons why household debts exploded through the mortgage market. We felt that blue line would begin to drift down given the incapacity to borrow and to pay. Now we've got both sides of Parliament in the election giving generous or fairly generous support to the housing market. And what that will do is push up the red line. If the red line starts going up again, guess what the blue line will do? It'll start moving up. So it's good to support the housing market, but it's got to be very concentrated. My final chart before handing over to Steve was just quickly on what Australia's poor energy policy. And this will become an issue. We don't think at this stage inflation's a big issue for Australia. It could be much better if we handled our energy market. It's a big debate in the election, as you know. There's no short-term solution because we've mismanaged it for decades. But you can see from the chart there, Australia, even though we're a net exporter of energy to the world, we have one of the highest energy costs to our local economy, our local market and businesses and consumers. It's an appalling situation, and most energy exporting countries have used that energy export, the comparative advantage, which is what we're talking about with trade, use the comparative advantage to their benefit. Australia has missed the comparative advantage opportunity to drive down energy costs, and we're wearing the higher inflation than we need, and the decline in the standard of living through the negative real income. That's all from me, and I'll come back shortly with some conclusions, but I'll just hand over to Steve, and he'll take you through the Australian equity market.
Thank you, John. Always a very comprehensive set of slides. I've got about 15 or so slides to work through with a focus on the equities environment. So we'll just run through the very high level and then move across into our concentrated equities portfolio, how we're being positioned, and what changes have been underway of late. So perhaps just to kick off with a simplistic backdrop. Earlier this year and late last year, in thinking about what may happen this year, a range of topics were on our mind. I've just highlighted in yellow two of the topics that we were talking about with our internal team and to clients. They are highlighted as Trump and the status of the US equity bull market cycle. On sentiment and Trump, we did not in any way predict these tariffs turning out so more heavy-handed than what has played out. But we did at least ask the question, prior presidential elections and change has generally arrived at a moment when equities aren't at any form of extreme, either overly bearish or overly bullish. But it was a bit different this time round. In November, you can see that we were at a point of maximum positive sentiment, begging the question, as much as Trump had in mind very positive signals going on regarding deregulation, cuts to corporate taxes, reduced bureaucracy, and so on, there was also the prospect of changes that may not work out so well, and that is what's happened. So we were very curious, and that fed somewhat into how we were positioning our portfolios. You would know that we talk to John and we allow for the high-level settings to have a level of influence over how we shape the portfolio. It does not dominate, but it does feature, and we are sensitive to the broader environment. So that was sort of the sentiment read. And then the other slide I like to put up and share is just one of taking stock of where we are in a cycle. And we know markets aren't devoid of going down. We observed late last year, early this year, that we were in an advanced phase of the equity bull market. There's no way to pick when it may change. All you can do is observe that in a status of elevated rating alongside robust earnings, that you are in a more advanced phase than prior phases where rating is not elevated, even if earnings are going up. So they were the two, I guess, pieces of the background that we were curious about. Well, what's happened since? And since Liberation Day, we've had enormous volatility. The chart on the right shows an index of various share markets starting this 2025 calendar year at 100 and rolling through time. It's been very varied, but perhaps common to all markets post-Liberation Day on the 2nd of April was an aggressive sell-off. And then in the last week, we've seen, prompted by a pausing of tariffs, a degree of recovery. Overall, as per the chart on the left, markets are still by and large down. In the case of the S&P 500, it's down 8%. The Nasdaq's down about 13%. And it's a bit of a mixed bag elsewhere. But for international investors, obviously, in any sort of broad allocation to international equities, the majority of money is going to those US markets. Our market's down 5% as of close yesterday. So I just thought I'd put this slide up. I'm not an historian, but we do look at data, and I thought it'd be worthwhile just sharing the context of the drawdown we're having this year. The last drawdown we had was 2022. The one prior to that was 2018. It can be forgotten sometimes that, yes, markets have calendar years of going backwards. It is a normal thing. And if you look at this picture here, we have 97 years, calendar years, of the S&P 500. As it turns out, 1 in 3.2 of those years has been a down year. If we also take account what has happened in recent years, the average decrease is 15%, including that year of decline in 2022. The US S&P 500 has averaged a return of about 14%. That is well north of the long-term historical average of 9%, excluding the 30s, or if you include the 1930s, the average S&P 500 annual return is 8%. And just the last stat would be the last 2 calendar years has seen the S&P 500 advance almost 50%. So again, we were heading into this year with an amount of observation that regardless of what it would take, whether it's tariffs, whether it's other issues, we were already concerned that we were in this advanced phase of the bull market. And just another comment here, again, I want to qualify, I'm not an historian, but as for the prior couple of charts, just sharing with you the quantum of decline we've had so far, that sits in correction territory by and large. This is a picture of all the calendar years. So there are just over 30 calendar years shown here where we've had a decline year for the S&P 500. And I've just arbitrarily labelled the level of decline in the area of either a correction, i.e. the economy's fine, earnings are fine, it's just an adjustment to rating. Recession would be the next leg down where you're dealing with actual contraction activity. So 2002 was an example of that. Oil as an issue for the world in the mid-70s. And then finally, crisis is when you get much less regularity, such as the GFC or the Great Depression, and equities fall, towards 40 to 50%. So we are currently in a place year to date where we're looking at correction territory. It is interesting. I mean, here is just a simple picture of what betting markets are seeing in terms of the risk of a US recession. It's all very humbling. We're following the news, and again, we are curious, but obviously, since what has happened, which is unprecedented, at least we haven't seen change like this for a very long period of time. It is interesting to see markets have oscillated around recently, but have by and large moved from what was a 20% probability of a recession. That's pretty bulk standard for many. You have to put some probability on some sort of left of field shock, but that has now risen and settled at around 50% at the time of print. So what might this mean for how to think about where to from here, and upside and downside? And again, I'm putting sort of a bit of a strategist and top down hat on here, and that is in contrast to what we do investing your money in a concentrated equities portfolio. But just to help you perhaps think about what could play out over the balance of this year, again, the S&P 500 is down from where it started. But as you can see on the chart on the left, even for the bounce we've had back, I mean, we're still sitting at a relatively elevated rating of about 19.3 odd times. So what does that mean? Well, what it means is on the table on the right, I've just shown some broad brush scenarios of how the performance of this market may play out under the various scenarios of there's no earnings problem and current 12-year forward earnings for the S&P 500 of 280 holds, or we have a 5% setback, just as a scenario, which I've labelled a mild recession, or we have something more significant and earnings fall up to 15%. Under those scenarios and under various multiples, you get different outcomes as to where we go from here. So on the most benign of scenarios, we go back to 20 times, earnings are fine, and the US S&P 500's got room to go up. At the bookend of an extreme being we get a more major recession and the S&P derates to something around 16 times, it could still get very nasty from here. So I don't have a strong view other than to say I would I would want to think an amount of what has manifested so far and a very uncertain outlook would still leave us with a thought there's still a little bit of risk to the downside. But again, taking that with a grain of salt. And just here, we have a different market here, as we know, a very different situation. First and foremost, it's Australia without a direct trade war going on. The most obvious point to make is direct tariff implications aren't jumping off the page as you work your way through the market. We've all pored over the portfolio. We've thought carefully about individual stock influence, but at a broad brush level, it is less about the direct implications for this market and more about the indirect implications. The indirect implications can simply be described as how an interconnected world of households and businesses and governments will change investment and spending conditions in the period ahead. That is what we are watching, and that's what we are sensitive to. And that is the Australian market is not going to escape the scenario, which is, again, only a scenario of material revisions to those spending decisions. And so we are thinking carefully about that, what that means for our market. Just one final chart to leave you with on the high-level backdrop. You've probably picked up, and we did a quick bites piece on this just in the last couple of days about the status of bond markets. And John talked about this. I find this quite fascinating that we had initially a rally in bonds followed by a sell-off in bonds. Bonds have backed up, and that wasn't the plan. If anyone thought there was a plan for the government to engineer some sort of sell-off in equities and a bidding up of bonds, and that gets the cost of debt down that John has talked about being so important to containing the debt servicing costs of US government borrowings, it's not working out. That amount of the bond market still matters to how equities get valued. The building blocks of valuing equities involve starting with risk-free interest rates and adding risk premiums. And I just thought this chart would be interesting to, again, remind you, much as we've had a sell-off and markets are down, to the extent bond markets aren't rallying, i.e. yields are not falling, that is still leaving us with this picture of a fairly underwhelming view of value from equities relative to bonds. So let's change topic now and get more into our, this is our model portfolio of the Rolton Concentrated Equities Fund. This is a fund of 23 stocks. I have just put up some high-level statistics up the top right, comparing it to the ASX 200. As you can see, at a high level, it can look as though there isn't a material difference in high-level metrics such as price-earnings ratio. We certainly have signed up for better growth, which I can talk more about relative to the market. You would know the ASX is somewhat starved of growth. It is a market from a total shareholder return perspective about equally comprised yield and growth. And our dividend yield compares roughly at about 3.7%. But the real difference, and this is shown through in our performance just in recent months, as I mentioned at the outset, we started this year defensively positioned. That has worked out very well in light of the changed environment. And on top of that, we've been fortunate to make some changes to the portfolio. And through the February reporting season, we had a really good hit rate on the stocks in the portfolio to see us outperform. The two pie charts shown there just provide a high-level summary of how we are positioned differently. And the highest order observation to make is in those two first slices of each pie chart being financials and resources. We have made a deliberate decision to be tilted away from the major banks and the major iron ore miners to pursue companies with superior valuation prospects that can be had at the right price. We can talk about the individual stocks that sit behind that, but by and large, our strategy, and it's somewhat of a structural strategy rather than thinking it reflects the ongoings with tariffs and more recent developments, but we foresee a future of these very large companies, as incumbent as they are, as mature as they are, as well capitalized as they might be, they are constrained for growth and opportunity to create value. So we have invested elsewhere. An example of where we've invested elsewhere is in healthcare. An example of where we've invested elsewhere is in real assets. Real assets comprising names like Transurban, names like Goodman Group, names like Cube. So that is the complexion of the portfolio. It is an underweight banks and big cap miners. We are overweight gold. We've been very fortunate to have Newmont in the portfolio. We have healthcare, as I mentioned, a defensive sector, and we have real assets. And of course, real assets are positioned to benefit in the forward setting of what looks to be imminent further reductions in policy interest rates. And just lastly, we are underweight tech and ultra high PE. Quality at any price is something that I've talked about, a concentration of a handful of names in this market that have overachieved. They certainly have come unstuck, and there's been a repricing. We are yet to do anything significant on that front, and the reason is they have just returned to respectable values or ratings as opposed to dirt cheap. But we are continuing to look for opportunities, and we will get more opportunistic the more volatile conditions get. Here is just a short summary of our holdings. So I have bluntly split our 23 stocks between either standing from a total shareholder return perspective for income and yield, or alternatively for capital growth, i.e. no yield. And happy to take any questions on those stocks later. What have we changed? Please don't look at the stocks listed on the right there. They are not the names we have changed. They are just names that the investment team has been doing research on lately. The changes that we have made, we were a 25 stock portfolio a month ago. We are now 23 stocks. We sold 2 positions, one Light & Wonder, the second was Worley. We are already at altitude on cash, so we took those exits, didn't add to our cash position, and instead topped up our position in Goodman Group, and we also moderated our underweight in CBA, just in recognition from a risk management perspective. We had planted the seed. CBA trades on a hard to understand multiple, and yet it has not flinched in this sell-off, and we are humbled by that, so we have moderated the size of our underweight. We still remain underweight. This is just a quick slide to discuss why we sold Light & Wonder. This has been a position we've had for some time. They're a gaming and content company based in Las Vegas. Most of their earnings are simply from electronic gaming machines and games sold to casinos and therefore consumers in the US. To be honest, we had a finger on the trigger on this one to the extent that we've been doing a lot of work just putting them head to head with peer aristocrat, and our investment framework here being bottom up and looking for above average wealth creation prospects sort of brought to light a couple of features of the Light & Wonder business model, its mix of earnings, the quality of its earnings, and also I should mention balance sheet. There really is daylight between the balance sheet of Light & Wonder and Aristocrat, and where that arrives is you would have seen so many stocks in a downdraft when they have a balance sheet not positioned for a softer environment or a downturn. Things can get very ugly very quickly. Spark Infrastructure is an example. VEA is an example. Fortunately, we have an alternative to that. And Mineral Resources are high-profile examples as well. So we decided let's not outstay our welcome here. The US consumer environment's softening, the risk-reward skewing to the downside, so we exited that position. This was another one we exited, and we also had our finger on the trigger to some extent, just noting in the top right chart, that's a simple picture of share price delivery over time, and the coloured lines are earnings revisions, start of fiscal year to end of fiscal year. So much as Worley as a global construction and maintenance service provider with a very strong incumbent position, that has put a lot of runs on the board in recent years. The longer term perspective is one of being reminded they do have a somewhat compromised track record of value creation, and that's just because they are serving highly cyclical end industries. It's about 50% energy, it's about 30% resources and 20% chemicals. So in light of what's happened, the operating environment has deteriorated. And as a result of that, we're concerned that, as I said before, one of the worries we have about what Trump has done simply is shocking confidence to stop the spending decisions that otherwise would happen. And so therefore we decided to exit that position. And what did we top up? Well, you'd know the story of Goodman Group, founder-led, strongly capitalised, exceptional assets, an exceptional strategy. They recently did a cap raise in all things pursuing a new opportunity in data centres, where previously the company had delivered a lot of value creation building for the e-commerce sector. You can see on that chart on the right that it has not escaped the sell-off in markets generally. So we thought we'd take the opportunity to top up the position. It was a relatively small position, fortunately, heading into the downturn, just recognising it's hard for rating to go much higher when it's so well liked. But of course, now that it's sold off, we thought it'd be worthwhile topping up that position. I'll now hand back to John.
Okay. So as Steve mentioned on downside shocks, downsides to markets over a long period of time, the flip side is, yes, 25% of the time markets go down, 75% they go up. So looks like 2025 for the American market in particular is probably a negative market. On all the scenarios we are looking at, unless there's a dramatic pivot in the policy, tariff policy, it looks like America's stock market, which has run strongly in the last 2 years. You can see the green lines on the far right. 2 very big years, probably followed by a year either red or around zero. And the reason we say that is because of long-term returns. And I think you should look at this because it gives you a flavour for what is normal and what is abnormal. So I've put down all the different asset classes here from Australian dollar perspective and had a look at what sort of returns have been generated across asset classes over a 10-year period, which is I regard as longer term, and more shorter periods. So if I just grab something like Australian ASX financials, which is the banks, you can see an extraordinary performance over 3 years and 1 year against a long-term performance. Banks are normally fairly predictable generators, going to get more upset in downturns than upturns. I could show you a chart or table suggesting that the extraordinary performance of the banking sector in the last year has been through PE expansion, not earnings growth. And that's probably pretty much symptomatic of the last 5 years. So they have generated above normal long-term returns. We're not suggesting they're going to fall, but even a sideways movement, slight increase will bring them back to a more normal return. Looking at resources, we've had a very big negative year, 2024. More normal is around 10% type returns. So you're probably looking for a rebound at some point. A rebound in a trade war, interesting conundrum to think about. As we talk, and we have our morning meetings, we look around the world, commodity prices, metal prices. Metals prices in the main have been quite resilient. We've still got copper around $4.50. Did go above $5 going into the trade war. Looked like it was going to breach 4 on the downside, but it's recovered to a mid-4. A true industrial metal, which tells you that the metal market is suggesting that whilst there's a downturn, and you go back to my opening remarks, yes, there are downgrades coming for world growth, but there's not a worldwide recession coming. And there's aspects of the world, particularly, as I said, NATO, investment in defence in Europe, that stimulates activity, and it draws upon metals and commodities. So there are things happening in the world which is not all negative. There's some positive things happening. And when we analyse the world, we need to balance the negatives with the positives. I'll go right down the bottom and have a look at government bonds. So the government bond market in the last year, 3 years, 5 years has been particularly poor. But the issue is it's been particularly poor for a long period of time. I've been on the record saying that bonds weren't fit for purpose. And Steve made the point in the recent kerfuffle in markets, was there a push up in the price of bonds or decline in the yield? No, there wasn't. And that's because bonds remain, in my world, in my analysis, mispriced. They're not a great place to invest. This is government bonds, not corporate bonds. And you can see there in the 1 year returns that corporate bonds have generated a 3% better return than government bonds. And over a long period of time, they always generate a much better return, as they should, because they're higher risk. But you haven't had the drawdown in corporate bonds as you had in government bonds. Our point is, and I'll finish when I go to talking about asset allocation, there is a strong argument to have, as we push more into income in this uncertain period, that corporate bonds and similar sort of securities come into play. First mortgage, asset securitization, bank debt come into an income portfolio, not government bonds. Government bonds don't protect you. Cash rates, you can see the effect of the Australian Central Bank putting up interest rates. So we've got a cash rate return over the last 12 months of 4.5%. We expect that return to go back below 4% looking out. Gold's had an extraordinary performance, continues to perform very strongly, as you would expect. Now, that could well accelerate. Now, why? Because the US dollar is going to weaken. Now, it's done very well over 10 years with a strong US dollar. Gold price has gone up. So didn't excite a lot of people for a long period of time, but it was actually revaluing in Australian dollar terms dramatically. And that revaluation is continuing as we speak, hence the investment in Newmont. The other reason, these are compound returns, so I should reiterate here, the reason why interest securities don't compound is because they pay out interest and the owner of the asset usually takes the interest and uses it for other purposes. The equity market is more tuned to reinvestment where you get the compounding benefit, okay? So we need to understand that. If we were full throttle growth, putting in more risk in the portfolio, you slant to growth stocks and you use your compounding. When we're a little bit concerned, you slant more to income. You get your income generation, you as the owner of those assets get the cash, and you decide, or you and your advisor decide what to do with the cash. Now, there is some requirements to take a pension. We're aware of that. That's an individual discussion. Outside the pension, the question is, as I get my income flow, where do I reinvest it? Okay. Now, best not to do nothing. And what I'm seeing now, I would expect corporate bonds, which are backed up a bit. So we've got a better yield on corporate bonds than we had a month ago. And the expectation is for cash rates to come down. I'm not greatly bullish on the bond market, especially if the Australian bond market follows the US bond market. Okay, so some discussion points. This might lead us into some questions. Now, I think we've outlaid the issue with America, which the Trump administration is addressing. The American economy has attracted a massive amount of worldwide capital. You can see it on all its external accounts, trade and income accounts. So it's running a massive external deficit, and it's also running a massive internal deficit. The internal deficit was substantially funded for a while going into and out of the GFC by China. China was a big supplier of capital to America. It seems to have stopped about a decade ago. This view that China owns a lot of American government debt is wrong. As you saw my earlier chart, it's about $800 billion out of $32 trillion. So it's a big holder, but not a significant holder. Would China sell those bonds? Well, if we had another deterioration in a negotiation, which hasn't started between America and China, you may well see that sort of kamikaze act. But at this stage, they haven't done that. And that's where they hold a substantial part of their foreign reserves. If you think about it, that's $800 billion of their foreign reserves sitting in the American bond market, which they can use if they need to bring it home to stimulate their own economy. So they do have quite a lot of firepower. That's not the case of America, okay, who's excessively borrowed off the rest of the world. The allocation of capital and debt to the American economy, and Australia is falling into this trap, and we need to be aware of it as self-directed retirees and advisors. there's an increasing concentration risk by being invested in the US. Now, when it works in your favour, as it has clearly in the last 2 years with revaluation of the American stock market 20% compound, with a rising US dollar, and expansion of PEs, but also earnings growth. So everything's a huge tailwind for American assets. You'd have to say now there's quite a significant headwind appearing. Now, you could say that also is self-inflicted because of the administration change and the change in policy, but that's what it is. It is actually existing in front of our faces. To a lot of extent, investing in America the last decade against a rising increase in debt and a declining fiscal policy and trade account, we did so, the world, when I say we, the world external to America did so with our eyes closed. We were happy to take the risk because we're getting the return. That's, to an extent, is now unwrapping, and we can see clearly the risk we're taking by investing in America as they now have to deal with their issues. Those issues are clear to see. So it goes to the third dot point, American government deficits and debt. I remember saying last year I thought 2025 would be a year where the bond market awoke from its slumber. Well, it's being shaken out of bed by Trump. And the US bond market is exposed. Government debt needs to be addressed. The government deficit needs to be pulled down, and so does the trade account. The overvaluation of the US dollar needs to be thought about. Now, I've got the fourth dot point down. I end the sentence with, "will need central bank support." And I'm becoming more increasing to the view, and I'm not alone. I think that if you go and listen to some deep thinking analysts on YouTube and listen to some analysis, and if anyone's interested, I can send them to you. There's an increasing view that the central bank will need to get more involved. Now, my view is the Central Bank of America is just watching events unfold. I liken the American economy now to a plane landing, and there's a lot of people trying to land this plane on the plane, and the central bank's running the radar, trying to help it land. So there's people working on the currency, there's people working on the trade account, there's Elon's working on the fiscal account. Hopefully the wheels are coming down so they can land, but there's a lot of work to be done to land and stabilize this plane. After they went through it, they've actually driven into a storm. A plane can go around the storm, they've driven into it. So they've really got all hands on deck trying to work out, and they've created arguably more problems than they needed to, but there is a big problem to address. I suggest that the central bank is watching and saying, we'll see how you go, see what you can do on the trade accounts, see what you can do on the inflation, see what you can do on oil, see what you can do with your fiscal situation, see what the US dollar does, but they are ready to act. They may not be ready to act if Trump is in full control, because you have to understand where we sit. He's taken over war powers to take directional control of massive international policy settings away from Congress. So he's doing it without their approval. He's making unilateral decisions with his cabinet. Now, at this stage, the Congress seems to be happy for him to run, but don't be surprised if they get worried and they try and pull some of those controls off him. I don't think the Federal Reserve will move with Trump being totally in control, so to speak. The administration, the Federal Reserve, and Congress, Treasury all have to work in unison at some point. But at this stage, it's the administration with Treasury who are running ahead of the pack. The issues are significant for America. They have to be addressed. Arguably, this administration had to address it because the next administration would have to do it. We can debate about how they've done it and the ramifications, but don't think that the Federal Reserve will not act if it has to. Now, we can't regard that as an insurance policy, and the insurance policy is printing of money, but I think we are heading to a point where America follows Japan in terms of printing money, and we've got history in Japan, debt to GDP 250%. They didn't implode. They printed a lot of money, and they took over the bond market. They forced out foreigners. And the more I think about it, the control of the bond market is going to be essential for these policies to be driven through the American economy. Okay, And the warning we got last week where the bond market got destabilised suggests quantitative easing is coming back. We have to do a lot more thought about that because there's various scenarios which flow from that. One argument says that's very bullish for asset prices. Another argument says, well, that could be quite depressive. So it's not an open and shut book. Okay. And remember, Japan had 20 years of rolling recessions, printing money, very low interest rates. Very low interest rates don't mean massive stimulation in economic activity. They might mean speculative activity, but not economic activity. Clearly, if the tariffs roll through, we've got inflation rising in America, not declining. So US inflation was on a substantial downturn. The recent inflation reading in March was negative for the month. So that's going to start going up again. So we've gone from looking at absolutely certain interest rate cuts to now no interest rate cuts unless there's a downturn in the American economy. And we're too early in the cycle. Tariffs have just been implemented to some extent. Threatened tariffs haven't been implemented. American economy has not even dealt with the issues as yet. So we can talk about the risk of, which Steve's done, the risk of recession, but at this stage it's a risk, not an actual, and markets are moving all over the place trying to work out where a recession. So everyone's watching the numbers, so are we, and we'll keep you informed. In the meantime, we're adamant. If you are thinking about investing, you want to be well diversified, more than normal, and you want to probably be more focused on yield more than normal. And it's not as if yield is not available. If you go back to COVID, we had no yield. And luckily we were all at home looking at the TV, because if we were looking at the markets, you would have been panicking in terms of where do I get a return for my money. There has been a substantial recovery in income markets. The cash rate in Australia, as you know, is well over 4%. It was close to 0.25 or something, 0.1 in COVID. So that's 4% better. Inflation is coming down in Australia. I've put to you the case where there's an argument that China may deflate its trade partners through excessive exporting away from America. That would drive inflation further down. We've had a substantial decrease in petrol prices coming from international oil markets. Petrol today in Sydney is about $1.50, $1.60 a litre. We see across Australia petrol prices coming below $1.50. They were $2 a year ago. Electricity is still a concern as a cost of living issue. We've got mortgage rate cuts coming probably as soon as May, and a second one probably in August. So inflation readings and the cost of living seem to be improving. So the yields we're seeing compared to inflation outlook, they're becoming quite attractive in a world which is becoming quite disjointed. So we're suggesting from the investment team to talk to your advisors about, there's not many times you need to rethink about asset allocation, but I think the jolt suggests it's time to rethink. And if you're not prepared for excessive volatility and you'd like to see more yield, we do have the solutions available. We've been thinking about this for quite a while, so it's not something we just came upon. We've been thinking about restructuring our income fund inside Clime, and that's showing a much better yield. Developing new products to go into the corporate debt market and the mortgage market at much higher yields than generally available, acknowledging the risk, and we can explain the risk to you. Acknowledging that we think the equity market, whilst it'll still perform over a long period of time, there's going to be some issues given what's going on around the world today. So that's the presentation. I hope that made sense. Very happy to take questions in the final 5 or so minutes. I don't know if Gareth, you got any questions there? Want to throw at us?
Thanks, John and Steve. That was great, comprehensive presentation. Just conscious of time, I've got a few questions here that have been flowing through. Some stocks, some macro related, but I'll maybe start with one that can be combined. So, are there any particular sector or asset classes in Australia that you believe are more insulated or perhaps will benefit from these renewed global trade tensions? And then the follow-up, which is another question, and have you made any specific changes to your portfolio since Liberation Day?
Sure, Gaz. Yeah, the the two changes I mentioned earlier was exiting a US consumer discretionary stock called Light and Wonder. As I mentioned earlier as well, we already had our finger on the trigger observing an element of consumer spending at altitude over there and prospects for a slowdown. So that Liberation Day was a catalyst to take action. And we also, with an amount of exposure to energy, decided to exit our position in Worley on concern that, the shock to confidence, which is critical for capital spending decisions, whether resources companies, chemical companies, energy companies would become problematic. So they're the two active decisions that have been made, with what I said before being we already had some reservations or an amount of observation that the value creation features of these companies had a bit of work cut out. In terms of the question of what could benefit, or that's a difficult one. It certainly we've run through the 23 stocks in the portfolio to, at first and foremost, what are the direct implications? Is there anything jumping out where we are exposed? So if you own Breville, as an example of that, you have direct exposure because they're manufacturing their appliances in China, and the US is a significant market. So upon reviewing the positions, we don't have names we can volunteer. The probably one that we're watching and a bit curious about would be CSL. CSL's made Chanticleer today, and many analysts have already delved into the scenario modelling on tariffs. It's not yet complete because we are yet to hear what specifically will happen. I would note tariffs in the past haven't actually hit CSL because their IG is not classified technically as a pharmaceutical. So we're working through that. What might we also be thinking about? I would just want to put the macro down for a minute. I mean, we've just noted to you we've lightened the load on consumer discretion in the US, and John earlier described a per capita recession for spending in Australia. That is set to shift and change, and to the extent we don't currently have a consumer discretionary stock that's Australian-centric, they're names like Wesfarmers, they're names like Super Retail, they're names like Premier. That is sort of moved into the foreground somewhat. So opportunity at all times is about market-leading stocks that are well capitalised with strong value creation potential, and the operating environment is thought about, but it is never central to a thesis. It is just in the mix, but that would be where our energies are channeled from a stock selection standpoint at the moment.
And I'll just add, I think on a sector, the one that is resonating in an election is the building sector. And the struggle we have is that 30 years ago, you had a plethora of choice to invest in the building sector of Australia. Now it's just been decimated with takeovers and privatisations. Yeah, we are having a look at brickworks again. So that's likely to come into some portfolios. It's already come into some portfolios, but there's a stock which I think whoever wins the next election, there's a massive undersupply of housing in Australia. So that's away from the trade war. So I think we've got to be very careful. Trade will have some impact, trade issues, but there's some domestic issues which have to be addressed. Just like the defence issue in Europe, the housing issue in Australia was going to happen. And even if it was a downturn, it's going to happen.
Great. I think it's a topical one, given it's a large part of the market and a lot of portfolios. But how do you both think that the banks will tread in a global disruption environment, and do you think they're in a good position to get through this period?
Can you just repeat the last part? Trigger what?
Sorry. So the banks, so the global disruption that's going on right now, how do we think they're in a good position to get through this period?
Yeah. Okay. I'll give you my 2 cents worth on the banks. I think structurally they're challenged. The big four banks, as described earlier, there's an obvious bifurcation in the ASX being across the big four banks, the big miners, Telstra, Woodside and Woolworths. You have about 40% of the market in the struggle street category. Again, they're not sunsetting businesses. They're just challenged to grow because of their incumbency. The domestic banks are the same. They only operate in this market. It is highly competitive. And I debate this with my colleague Will Wriggle. I do not foresee goodness from falling interest rates from the key value driver of banks being their net interest margins. Not all of their deposit book flexes down as interest rates come down, but their assets will flex down because they will deliver, as part of a social license to operate, reduced mortgage rates as policy rates come down. So without trashing the banks and calling them a problematic part of the market, I think they are struggling at altitude. They rose 30% last year collectively as a sector, and that was overachievement relative to their earnings delivery. So it's an underweight for me. If you thought about upside downside, the base case is they hold their earnings. Again, they're very incumbent. Households are resilient. They're not like businesses. Businesses, when they come unstuck, can fold. Households, there's a lot of support. There's unemployment benefits. There's ways in which households navigate through, and that is the history of banks. But banks don't have, they're well capitalised, but we're at a low on provisions. So my thinking is, at best, they live up to earnings expectations, and at worst, if we had a total calamity of a GFC type event, banks will show their cyclicality. Their earnings will decline because they will raise provisions, and their share prices will fall because they're leveraged. So that's my 2 cents worth on the banks.
Great. And maybe we'll just keep it to two more, because I'm conscious of the time. But you've mentioned during the presentation about the bond yield sell-off, and you've also talked about some interest in some yielding stocks. But how should we be thinking about interest rate sensitive stocks in the current environment with the bond yield moves?
Yeah, okay. A couple of things to note there. So as per John's comments about the importance of a degree of defence, again, marrying up bottom-up research of the attributes of companies and what they can offer, from a total shareholder return perspective, we do have a tilt towards, and you saw this on a slide earlier, Garth, with our total holdings. We had more income stocks than we did growth stocks, and that is where there's a slight tilt, and that includes a lot of interest rate sensitives. What happens as bonds move around? Well, we do think about that. We're sensitive to that, and it's somewhat unhelpful that bonds have softened, and it's a bit counterintuitive that they've softened given the weaker indicators out there. So where does that lead? Well, the point I probably should share is, if you're focused on the very short term, you will see a connectedness between how interest rate sensitive stocks we have, for example, Transurban in the portfolio. It will move around with the bond rate. But if you look at the longer term picture, it defies the bond rate because it has an important attribute of wealth creation called growth. These distributions find a way of growing. And so if you're too focused on the here and the now about describing Transurban as a bond proxy, and it does have bond-like attributes, highly certain cash flows that do not show economic sensitivity, it is just a discount rate debate as to what sort of price you pay. If you focus too much on that short term, you miss what is the bigger picture of a strong incumbent business. They have very little US exposure, as you know. And those roads keep growing, fed by population growth and GDP, with attractive pricing on top, and that allows them to deal with any future scenario of the bond rate staying where it is, or even if it went higher, it still represents good value from where we sit.
Yeah, look, on the bond market, I think we had a sign last week that 4.5% was some sort of line in the sand where there would cause a pivot in the policy settings of the Trump administration. So we hit that, and there's been a lot of changes to the proposals regarding tariffs. So that's come into play. internally, I think 5% on a bond would be serious problems for America in terms of, I showed you earlier, how much of the bonds are being rolled each year and how much is being issued, and that straight line up in the interest bill. So a bond yield, in the back of my mind, I just believe that the Central Bank of America will come in and support that bond market. They'd be less likely or less keen to support it if the administration is running the whole show and not Congress. So just watch this space.
Great. And just one final one. If the US tariffs persist, do you see a resurgence of potential onshoring or the friendshoring theme? And is there any potential investable implications for Australia?
So if the tariffs go ahead, is there a...
So the changing of onshoring of different manufacturing.
Oh, yeah.
You know.
Yeah, look, I have some real doubts about how much America can onshore manufacturing and in what time. So there's two issues. Can they do it? One, and if they do it, how long will it take? And there's another issue which I keep on reflecting upon. Why build a manufacturing site in America when you can own one somewhere else which can produce cheaply? I think the American corporate sector as a whole, multinationals, have missed opportunities to actually own offshore manufacturing and therefore get the benefit of an increased profit margin and more income coming in that trade account. So and I showed you that in the earlier part of the presentation. I think America needs to think about what's sustainable, where it has relative advantage. Does it have relative advantage in a highly skilled workforce? There's some issues regarding its education of its population. It's also its skill basis. I think there's a huge entrepreneurial flair, which is fantastic. Technology, fantastic. Manufacturing, have they really sustained that ability? I put a big question mark over it. Maybe they can import the workers for that, we know Trump's unclear on his immigration policy. He certainly doesn't want to take unskilled labour. So they've got similar issues to Australia. Opportunities, I think it's in those manufacturing areas which can use robotics and technology. So it's not, I don't really see America being a driver of manufacturing labour, more manufacturing capacity through technological developments, which they can do. The shocks being done, I guess go back, the shocks as being created, the issues being defined, the issues which America needs to address. The answers specifically to your question, I don't think are clear at this point in time. I don't think we can say there's clear winners or losers. Too early.
Great. Well, that's all the questions we've got for the moment. So I might say thank you to John and Steve for the presentation today. It was very comprehensive and very useful. And thank you. And if you have any further questions to the listeners, feel free to reach out to your advisor or specialist, and we will be also making a copy of today's call available online for viewing later. So with that, I'll end the call now, and just one last thank you for all attending, and a reminder that we're available if you've got any questions for the rest of the day and rest of the week. Thank you very much.